What is capital gains distribution in mutual funds? Imagine you invest in a mutual fund and it performs well. You might expect to see some profit, but did you know that you could also get a tax bill even if you didn't sell any shares? That's because mutual funds sometimes distribute profits to investors in the form of capital gains. These payments are called capital gains distributions. When a mutual fund sells securities like stocks or bonds for a profit, it must pass those gains on to its shareholders. This usually happens once a year, and the fund reports these distributions on a tax form called Form 1099 Div. There are two main types of capital gains distributions. Short-term gains come from assets the fund held for 1 year or less. These are taxed at your regular income tax rate, which can be higher. Long-term gains come from assets held for more than 1 year. These are taxed at lower rates, which could be 0, 15, or 20% depending on your total income. As someone involved in stock trading or options, it's important to know that you don't control when these distributions happen. The fund manager decides which assets to sell and when, so you could get a taxable gain even if you didn't sell your shares. This is different from trading stocks or options, where you choose when to realize gains or losses. The distribution date is called the record date. If you buy the fund just before this date, you will receive the distribution and owe taxes on it, even if the fund's value drops afterward. This is often called buying a distribution, and it can catch traders off guard if they aren't paying attention. In accounts like individual retirement accounts or 401(k) plans, these distributions don't cause an immediate tax. But in taxable accounts, they do. For active traders, this can mean unexpected tax bills, especially when markets are up and funds have large gains. To manage this, many traders watch for estimated distribution dates and amounts, which funds often announce late in the year. Some choose to sell their fund shares before the record date to avoid the tax hit, especially if they are in a high tax bracket or the distribution is large compared to their cost basis. Others might prefer more tax-efficient investments like exchange-traded funds, which tend to have lower capital gains distributions because of their structure. So, understanding capital gains distributions helps you plan your investments better. They are a normal part of mutual fund investing but can have real effects on your taxes. Being aware of when they happen and how they work can help you make smarter decisions about holding mutual funds in taxable accounts and managing your overall investment strategy.